Welcome to the Beat the Banks podcast. I'm Kyle Fuller, and I've got David Zapata in here again. And today, David, we are going to have not a banking conversation, but an investing conversation today.
Yes, sir.
A very unique one. And we call this developing your unique investing strategy. Now, one thing that you and I believe, David, is that great minds talk about ideas. And one idea that we really love and celebrate here at Factum is that life includes 5 areas: spiritual, personal, family, financial, and occupation. And if you want to wake up and enjoy every second of every day, you have to create abundance in all those areas of life. You can't leave anything out. Otherwise, you start living with this, it feels like a void in your life. Your family life's not dialed in, or the financial piece is not overflowing. And we believe that the only reason winning financially is to go fund the missions in our other areas of life. And when we teach foundational wealth, which is all built off a saving strategy, it's a protection conversation. That foundation of what we call our wealth pyramid is non-negotiable, has to be the same for everyone, because you have to have similar saving strategy, a similar debt strategy, asset protection, tax efficiencies. Now, when you get to the top of the wealth pyramid, which is what we're going to talk about today, this is where the investing conversation exists. But your investing criteria and strategy has to be wildly different than anyone else's, because your vision for abundance in the 5 areas and mine look nothing alike. There may be some similar elements there, but we both want different things out of life, which means our investing criteria has to be entirely unique to you and I. So let's dive into this philosophy, because when I first started seeing hints of this through mentors and coaches that we're working with, it really helped me eliminate a lot of noise in my life, and it helped me get very intentional with what I will and will not invest in. And I only invest in things now that fit my ideal life in those 5 areas.
Yes, thank you for having me. This is a conversation I'm very passionate about, because not only I'm a man in the arena, but I'm a student. And we are very, very lucky to have great examples of success in this arena. A lot of people to follow, a lot of giants to stand upon. One of the things that I always tell you about is I love the thought of being the director of my own movie. And I want to choose who the protagonists are, who the actors are, the supporting roles, where I do the movie, right? That's I think life. Finding that idea of the 5 areas of life has been so powerful, because it helped me unlearn, relearn, replan new ideas on my paradigm in the relationship with money. And one of those was, money is so crucial in my life because it will allow me to express to the maximum potential things that are very meaningful to me, like the relationship with my children. And that is a personal feeling I have. Everything that I want to do with them now in the future, I see myself one day crossing the Ironman finish line with my kids. Like, that sounds silly to some people, but to me, I get goosebumps thinking about that. And in order to do that, I have to have the ability to have the freedom to do that, the ability to pay for it, the ability to have the space to train and have health in my life in the future. And financial life is connected to every single one of those little things that you imagine for yourself. Now, you mentioned our framework, the wealth pyramid. It not only is a personal endeavor for me to express those views of abundance for me, but the other part that it unlocked for me was, okay, I need to set up a foundation that is same for you and I, whether we have $1 million in cash flow a month or 1,000, it doesn't matter. But at the top, one of the things that I've always told my wife and my family is, I don't want to condition who my kids become. I want them to express and find who they want to become and express that to the max potential. And when you get to the top of this pyramid, you have to be very intentional to recognize for yourself or for the people around it, for the clients we serve, that this is a conversation about alignment. You need to find a way to align, become aware, first of all, and then align who you are, your values, your interests, your lifestyle, and align your financial life so it has harmony with everything else around you. And the difficult part of this is that we live in a world where we're constantly bombarded by media on, oh, you should invest in this, you should buy digital real estate and cryptocurrency. Like, you open your Instagram and it's just ad after ad of, oh, this is the way to make money and there's only one way. And Alex Ramosia has this quote: in a world where nothing matters, then you get to decide what matters. So you better be careful what you choose. I'm butchering the quote, but it's something in those lines. And it reminds me, the responsibility here is in actually being very intentional about choosing what you want in your life, how it aligns to your values, how it aligns to how you want to interact with your community, with your kids. And that's what we're going to talk about. So less conversation about deal flow, specifically saying, oh, you should buy this property on Main Street 123, or you should buy this cryptocurrency that I just found out about, and more about how do we help people have a thoughtful framework to make decisions about how they send the money that they've collected in their savings to go work from them with high expectations that it will come back with more dollar friends.
And I think you nailed it with the word intentional. And I think that word intentional bridges the gap between investing and speculating. And it's so important for us to understand the words of money, because I talk to a lot of people, and I used to be one of them, who I thought I was investing when I was really speculating.
Yeah.
Makes you feel good to say, yes, I invest in a 401k or my old Roth IRA, until someone said, how much is it earning per year? I said, like, average, like 8 to 10%. Is that an average, or is that the actual return? I said, I don't know. I said, what are the fees with your Roth IRA? Couldn't tell you. I don't know how to calculate them. How much control do you have over the growth of that asset? None. Someone else does. All right, Kyle, were you really investing in that, or were you speculating with that?
Yeah.
Because that's what it sounds like when people go and they gamble.
Yeah.
What are the odds that you're going to win? Can you really, beat them at that game? No, it's not investing. It's speculating. It's another word for that is gambling. That's what I used to do until I had this framework. And once you understand, true investors almost never lose money because they have a criteria that they go off of. That's how the real ones get so wealthy, like Warren Buffett.
Yeah.
So let's talk about how much income was reported and generated by U.S. households between 1997 and 2006, David.
Yeah. We use this to bring perspective to people in our live seminars when we teach this class, right? That is a period of 10 years prior to the great financial crisis. And U.S. households produced 70 trillion, that's trillion with that T, $70 trillion in income for those 10 years. Think about that.
So before we go, my favorite visual of $1 trillion, because that number gets thrown out a lot.
Yeah.
This one is always the one that helped me understand it. You could spend $50 million a day for 50 consecutive years, and you still would not have spent $1 trillion. So in that 10-year time period, we generated $70 trillion through U.S. households.
Yes.
We are in the land of abundance.
Absolutely. It's not an income problem like you and I say all the time. And now the contrasting piece to this, to bring perspective, is 3.5% of those households had the millionaire category, meaning they had liquid assets, either investments or savings, of $1 million or more. Think about that. $70 trillion generated. Keep in mind, this is current, right? But to be in the top 99%, to be at the top 1%, so you make more money than 99% of households in America, you only need 500,000. And yes, there's billionaires making. Think about that. To be in the to be making more money than 99.9% of households in America, Kyle, you need to make $2 million.
0.01% of the income earners.
So we're not talking about this statistic being skewed because a few billionaires make, hundreds of millions or billions of dollars. We're talking about something that is distributed around the real Americans. And the truth is that $70 trillion that we generated, that we pay taxes on, only produce the possibility for people to have millionaire status for 3.5% of the population, which tells you that we don't have a problem of income. We have a different problem, which is what we're going to discuss.
We have a problem with keeping that money.
Yes.
And one of the reasons we know people don't keep it when it comes to investing is because most Americans are not really investing. They're speculating.
Yes.
And this is why you have to have an actual investing strategy to go off of, so that you know when you will invest, how much, into what. And once you have that framework, it's very difficult for you to lose in a money game ever again. And I always say, it's really easy to win when you never lose. But Americans consistently lose money every 5 to 7 years with market shifts and everything because they're not really investing. They're speculating. So let's talk about this investing strategy, David. So one of the things that we would encourage people to start with, once they have that foundational part of the wealth pyramid built, which is all founded on your education, your awareness, and your saving strategy, once that's built, we want to, one, figure out why we're going to invest in the first place.
Mhm.
I think if a lot of people had this framework in mind, they'd realize they're closer to their goal than what they actually think. Because if you spend the time to write out, what does my life look like when I'm living abundantly in all areas? And then we're just going to work it backwards. Okay, if that's what we want, what is the cash flow number that supports that lifestyle? There's our target.
Mhm.
Now, we talk about a minimum freedom number and then an infinite freedom number. In the big wide world, I hear it all the time. Financial freedom, it's $1 more in passive income than your current monthly expenses.
Yeah.
We've called that the minimum freedom number.
Yes.
That's just enough to where you can kind of make your job optional, but you're not living the ideal life. I want the target that says, if I want to take my family to Hawaii every year for 10 days and spend $100,000 doing it, if I want to drive a certain car, live in a certain home, give the amount of money I want to give every year, what does my infinite freedom number have to be?
Yeah.
Is if my minimum is, let's say, 15,000 a month, what's my infinite? Is that 100,000 a month? Is it 200? You see, you have to design that life first, then figure out what the number is that will allow you to do that. Once you have that down, I think now you have the framework of why you're going to invest in the first place.
Yeah.
I'm going to invest intentionally so I can take my family to Hawaii, so I can give to the charities and causes I want to. And once we're living that way, that's when we start waking up and enjoying every second of every day. So I think understanding why we're investing in the first place is absolutely key. Then it's a matter of, when do you even deploy some of your money to invest? We talk in so many episodes about keeping liquid reserves for protection. So what is the protection number we've built, and what will we invest past that? So for my family, we've arrived at like a 30% of reserves.
Yeah.
So if our savings and our liquid cash and our policies and in our bank accounts right now, as long as we've got 30% of that ready to rock and roll, I feel comfortable that I'm not going to make a decision that's going to bankrupt me, right? We're protected. Anything above that number to me is fair game. So that's what we'll use to invest in. Anything you want to add to that?
Yeah, but we've been in rooms where people that we respect that are very successful investors have spoken about this with a lot of confidence, and it's changed the way I think about it. I was in a room and someone was asking the investor, well, why do you have so much of your portfolio concentrated around real estate? What about 2008? Did you not take huge losses and a huge risk? And the guy went back with a statement that has stuck in my mind forever. He said, no, I do this because 90% of my knowledge, my expertise is in real estate, and I can price and underwrite real estate better than most people can around me. That's why I concentrate my understanding of this in my portfolio. Your assumption and your premise is flawed, because when you say that I was taking risk and I took huge losses during 2008, you're assuming that I was speculating, but I'm an investor. I had calculated and understood risk in my profile. And I also was well capitalized. For every property and every business I own, I had 6 months of expenses in my pocket. Think about the power of that. Not only you're aligning how your expertise works for the type of assets that you're pursuing and why you're pursuing them, but on top of that, you're sitting in a position where you have money to weather any type of condition coming your way. Yeah. I love that you express that in percentages. That's what I adopted for my family as well, because it scales.
Mm-hmm.
Having $1 million in reserves, that probably means that I have $10 million in values, right?
Mm-hmm.
I'm keeping a ratio. And for me, 30% is exactly what I want, because I wanted to scale with my growth. We've heard other people say, like I was saying, 6 months of expenses or a number. Hey, I want this amount of dollars to always be in my vault to feel secure based on my current financials. However you decide, but your decision, and more importantly, our empowerment to you, is make it clear, put it in writing, I would say. Have it in writing for your family that when you make rules for cash flow management and when to deploy money, that is something that everybody agrees and understands, because that's what's going to protect you and give you opportunity in the future.
And that's the protection part of investing,
yes.
Right? Investing without protection, that's a dangerous game to be playing.
Yep.
And so I think once you have the why you're going to invest, when do you deploy money to invest, now it's important to understand what type of assets will you invest in. A lot of times we talk to people and there's no rhyme or reason to what they're investing in. I don't know. I was told to diversify. And I'm always under the impression that diversification is what you do when you don't know what to do. Like if I was to go to Las Vegas and to gamble, since I don't know what I'm doing, my strategy would be, we'll put a little bit over there, a little bit over here, maybe some on black. That's what my strategy would be. Now, true investors don't do that. They take calculated risks and things they know and understand because it gives them an unfair advantage in the game. That's when you're starting to invest, is when you're making decisions off that criteria. So for me, when I go to what type of assets I buy, my family only invests in assets that produce cash flow. We're not interested in retirement programs or accumulation. It doesn't serve us. It doesn't help me reach my ideal life of 5 areas. To live the ideal life for me for 5 areas, I need a lot of cash flow. Cash flow is the secret that unlocks that life for me, is income coming into my life. So therefore, I cannot buy assets that are stagnant, that sit, and I don't have access to money for 10 or 30 years. That's why I stopped putting money into my Roth IRA. It didn't serve what my plan was. So for me and my family, we only invest in cash flow producing assets, which for us right now would be things like real estate, hard money loans, private lending, and more importantly, our business.
Yes.
Our business for us is, we're seeing the highest return there and the most fulfillment. So therefore, we invest intentionally there. And I have an unfair advantage in our business because I've got 10,000 hours of experience in this. So I would imagine I'm decent at that now. I've proven myself. It's easy for me to make money in my business. So that's where I focus on.
It's exactly what I was describing at the beginning about alignment. You've aligned your lifestyle, your interests, your focus, and your expertise. I was just going to point that out. And I know you are doing this because we're doing it together. The best cash flowing asset I can find right now around me in the current environment is me.
It's you.
I am pouring money into me right now in development, in opportunities, in my business, because I don't see anything with greater upside right now. And I on top of that, I'm excited about it. I love it. It's bringing more value to my family, more unity, is expressing more abundance in all areas of my life. But that's intentional. And that doesn't mean it's right for everyone, right? It's just what's true for me, perhaps for you. But again, getting very clear, putting this in writing and getting the right framework about what type of assets that fit all those things in the alignment for you is important.
Absolutely. So once we understand why we're investing, when we're going to deploy money into what type of assets, now we're going to shift and start looking at the time frame. So when we start buying these cash flowing producing assets, it's important to have your time preference dialed in as well. So we talk about, short-term assets, things you'd own for a year or less, mid-term assets that you'd own for like 1 to 30 years, and then forever assets.
Yeah.
So why is the time preference important in your opinion, David? Why would this be something that's crucial?
Yeah, I think the most helpful part of this framework for me is clarity of mind and clarity when making decisions. 2 people can own the same exact asset and have very different perspectives based on how long they think they're going to own that asset and what it represents in their timeline of investing. The perfect example for this, you mentioned short-term, mid-term, and forever assets, something that's related to our industry. We know of people in our circle, mentors of ours, that had whole life insurance policies for a very long time, a long time ago. And at some point, because they were looking at it as a short or midterm asset, they decided to liquidate it as the best opportunity they had.
Mm-hmm.
Not recognizing that every year that passes, that asset was more valuable, more efficient. And today they out loud say to us, I wish I would have had a different framework to see that that was a forever asset. And I wish I had it today. Organizing in this framework allows you to recognize, okay, this has a purpose and it's for a period of time. In the short term, I'll give a couple of examples: private money, hard money loans, flips, treasury bonds. We know a lot of people that are currently managing a portion of their liquidity, flipping 30, 60, 90 days treasuries just because it's, a very strong asset, very liquid. So there's clarity on the fact that, hey, this is going to be just for less than a year that I'm going to own this asset. And that clarity allows them to use for that purpose.
Yeah.
Okay. When you go to midterm, now you're thinking a little longer term. So if you own rentals, stocks, owner financing, if you're financing mortgages, for example, tax liens, build to sell, those are things that in the midterm hopefully produce cash flow, and that's your focus. But for the next, 1 to 30 years, they're going to be a strong part of your portfolio, creating value for your family. And I'll let you comment on these ones, but the forever assets then becomes the long perspective. And at the core of that, I would put whole life. I joke about this often to you, but out of all the properties I own and everything I own, I have a hard time seeing me having ever the position of a trade-off where I would, trade one of my whole life policies for any property or anything I own. That is an asset that likely will go throughout my life until the last day of my life.
And so understanding that just reframes your conversation around these assets, because certain things will come up and you know which ones are your non-negotiables.
Mhm.
The whole life is something that's never going to be sold. You just keep it going because it gets better every year. Commercial real estate, mobile home parks, large apartments, maybe it's your business. For me, the business is a forever asset. There's no way we're giving up all the ownership to someone else. It's something we're going to build for the next 70 years and transfer to the next wave of leaders to make sure the education we have and the clients that we're going to be able to serve multi-generationally speaking down the road. So the ability for me to see the business as a forever asset changes the way I treat it now.
Yes.
Now, if my business was a midterm, I'm going to sell it in 5 years, we would do way different things now with the business than what we're currently doing.
Yeah.
We're building infrastructure, investing money to make sure this will go the next 70 years. So to have the time preference criteria down is so important so that you can make sound decisions quickly on what assets you have. If you ever need to sell off a few things, you might go to your short-term assets versus your midterm and long-term. Those just you don't touch. You buy them for different reasons. Without that framework, then one of the stories that you were referencing from one of our mentors got into a financial pinch in the 80s, sold his whole life policy. He didn't understand enough about it or what it was. So that was something he just sold when that should have been kept. And once they realized that, they wish they could go back and reframe some of that. So the time preference, I think, is wildly important. So once we have why are we investing, when do we deploy cash into what type of assets with what time frame, let's get to the fifth criteria now, which is the returns, the risk, and the noise. When we first saw this framework, it literally changed my life. And this would have, if I had this 5 years ago, I would have at least $100,000 more dollars in my control right now.
Yeah.
Maybe more, because it's hard to really calculate the time value of money and lost opportunity cost when our time is involved. And so this ability to track your active income and your passive income with an example that we talk about with returns, risk, and noise. So for me, most people are looking for high returns. Yes.
That's
typically what everyone wants. I want a high rate of return.
Is the only variable they measure.
That's it.
Yes.
But it has to go deeper than that, because if we know what our ideal life is, we have to ask other questions, which is, if the return is very high, how much risk are we comfortable with that level of return?
Mm-hmm.
Because I've seen a lot of investments that will, they're saying it's going to 150% return next year. Okay, but what's the risk? Well, the risk is 100% too. This could totally go to zero, right? That's a lot of the speculation that I've seen. But then the other piece to it is, how much noise will it create in your life? A lot of times we start doing things and realize, I'm miserable. Why am I miserable? Well, because you bought a rental property that you are now the project manager and the property manager on, and it's taking you away from what you wanted to do, which is have more time with your family. So this asset you bought in hopes to free yourself just gave you a part-time job. But we're never taking these variables into consideration. Mm-hmm. So the framework that I've built for myself is, my active income has a very high return. We make a lot of money doing what we do as professionals because we bring the value to our clients and our people. Now, what's the risk for you and I to make a lot of money in our profession? It's very, very low, because we're professionals. It's easy for us to do what we do now. Mm-hmm. Now, the noise for my active income, I'll say, is very high. I'm still working weekends. I'm working early mornings. I'll work while I'm traveling. That's something I've committed to, though. I built that into my life because my active income with this business and what we teach people is my purpose in life. So to me, retirement's not even on the program anymore. It doesn't exist. I'm doing what I love to do. So that's what my active life looks like. So now when I go to my passive income criteria, that has to look very differently than other people who are planning on retiring because they don't want to have an active income their whole life. Mm-hmm. So when I go to my passive income, I'm looking for like a 3 to 4 on the return, not a 10. The reason I look for 3s and 4s on my passive income is because usually the risk is very low.
Mhm.
And more importantly, the noise is incredibly low. I cannot invest in assets passively that create noise in my life. And, a few years ago, I invested into a business because the opportunity looked good. The return looked good. I liked the people who I was getting into business with. And we all agreed that I would have a very passive role. Guess what? It didn't go according to plan. I spent way more time in that business and it was driving me insane because it was pulling me out of my active income. So I was actually losing money investing in that business, and it was making me more stressed because it created more noise in my life. And we got to a point where we had to restructure the deal. I took, a completely different role in the business, sold all the ownership to them, and we just created a private note that now they're paying me for. That brought the noise level down, the return up, and the risk down, which to me saved my life because then I could get back to my high active, high return, high noisy, active life, which is where I want to be.
Mhm.
And so had I had this framework before, I never would have gone into that business in the first place. But I had to learn my lesson. As soon as I did, I said, I'll never do this again. And I think if more people had this framework with the visual, so make sure you go to our courses on factumfinancial.com, go to our wealth building resource under IBC courses, and you'll see this conversation. Because when you see it with the colors and the numbers, it's such a good visual to pinpoint the exact criteria of how much return, risk, and noise you want in your life.
It's fascinating because within the same opportunity, the same deal, you change positions and roles. Think about that. An owner, an operator, although you committed initially quiet, it was very noisy. And then you move to say, hey, I should own the debt on this opportunity instead and participate that way. I reduce the return potentially, but the risk and the noise come way down so you can focus on what you want. And there's no right or wrong here. That's just your way to align your life. People may flip this the opposite way. They want a very quiet active income, low return, but they want to maximize their passive income. And that's fine. The point is get intentional about what you do with this framework so you can find better alignment for your investing life. We probably would be remiss to bring this framework to whole life. I think it's really important that we touch on that point. And I'm not saying it is an investment, it is a savings environment, but it makes me think about when the banks say that it's an improvement to your income statement. And I want to point this out. To me, when I think about this, whole life as a savings environment, I know has a great rate of return, great yield on my savings. So it is very high. I know that. It is very low risk because it has guarantees associated to it. So I don't have to do anything. I go to bed this month and next month my cash values will be higher.
Right.
There's no questions about that.
Guaranteed.
Yes. And then the noise level is not like I'm calling the insurance company every day to check if they already compounded my interest today or next day, right? I do this at a zero level. The scale doesn't go to zero, but I'm going to say zero is the quietest.
Yeah.
From a savings environment, think about dealing with flipping treasuries 30, 60, 90 days. Maybe not a big deal to you, but there's some noise associated to that. There's risk of changing interest rates, although low because it's low duration, right? Think about any other savings environment. Is there noise in dealing with banks? Is there noise on putting your money in a money market or a CD? And for you, it may not be. So be intentional about that. Yeah. I know for me, this savings environment is completely aligned to how I want it to be with respect to return, risk, and noise.
Yes. And what we love is when clients go through this, partners go through this, and they see this. I've had so many conversations recently in the last 6 months of people coming to me saying, that noise conversation changed my entire business. And we started saying no to like 6 things because we knew where it was going to go. Imagine having that framework in the future. It is so wonderful to be able to have a criteria like this. It gives you the clarity. And when you have the intense focus on things you actually want to do with this investing criteria, that's when you get to accelerate your results because you cut out all the fat and all the noise and you just get to move, and it's easier, it's more enjoyable, and it's almost always more profitable to do it this way.
Yes.
Now, I want to end with just this, David. I've always loved the phrase, an average salesman will try to sell you based off what you think you need right now. And someone that truly cares about you is going to show you a life that you need to live into. That's a becoming conversation, as you always say. And so one of the things that I love about what we've taught here is we will never sell someone on anything here. We will educate you. We'll give you the criteria so you can do it yourself. And this is so vital when it comes to the investing strategy because our lives all look different when we have abundance in every area of life. Our investing criteria and strategies have to mimic and reflect what we want that life to look like. So we should not be taking advice from someone who says, you should buy real estate. You should do hard money loans. You should get into business. If that doesn't fit what your life wants to look like, you should not do those things. Just because we do things doesn't mean other people should do them. So having this criteria, what I love is it allows clients and partners to come in here and build their own future for themselves because no one knows the money game better than they do. We all have unique abilities, and those unique abilities give us unique advantages in the money game. So having the criteria to eliminate the noise, increase our efficiency is literally life-saving. You will condense timeframes down by 10 or 20 years with this type of criteria, even though it's so simple. And I love that because is there anything better than when a client comes to you and sees this and then they say, I know exactly where all the noise is in my life. I'm going to get rid of it and I'm going to move forward with way more family time now because of this. There's nothing better than having someone tell you that, and we didn't even have to do it for them. That's why I always say we're not financial advisors. That's the last thing I want to do is manage people's money. We want to educate and empower so our clients and our partners can make those decisions for themselves. And once they're off and running, that person has been turned loose in the money game with so much certainty through this criteria that I just get so excited talking about this because this is what really sets people free.
Yeah. And I mean, from a spiritual circle conversation, Kyle, I know the images in the screen of your mind, in your imagination, are only seen by you right now. And some of them are actually manifesting around us, building a business, other things, your family, right? But imagine all the potential locked in what's in your mind. And I believe that's true for you. I believe that's true for me. I believe that's true for anyone in our community, anyone we serve. I know for a fact that I cannot express any of those things for anyone else but me. So our job, like you describe, is what if we serve our community by getting clear about these frameworks, by setting up the proper foundation and protection, and then enabling people to go express their uniqueness, their ability, their potential, the images in their screen of their mind to the way that they can only do. And that's why I'm grateful that somebody around my community wants to be a florist. I have no interest in doing that, but it's so nice to walk to the store and buy them, right? It's so nice that somebody wants to change tires around me. It's so nice that somebody wants to be the grocer. I want to serve people in this way. And when we all go towards that realization, we stop telling people what to do and letting them know you are the best person to decide what's best for you. With the proper foundation, we make a better community, period.
Now and in the future.
Yes.
Because what happens when a generation of parents starts to behave like this, and then their kids see the intentionality behind the wealth foundation, the wealth acceleration piece of the pyramid with this investing criteria, then it allows the parents to actually steward and build those interdependent relationships with their kids. So now we have younger entrepreneurs entering the real world at younger ages with way more preparation and tools.
Yes.
That has a compound and a ripple effect that I am extremely excited about seeing in the next 30 to 50 years.
For sure.
Isn't that cool?
Amazing.
I love it. So if you enjoyed this podcast, make sure you tune in and subscribe so you can get more content in the future. And also check out our video series on our website, factumfinancial.com, to get all of these conversations with our free courses, our resources, where you can see all the numbers and the graphics behind these wonderful conversations we're having.